So it was really cool. I spoke to a high school class yesterday, and I basically titled it "Who Wants to Be a Millionaire?" And of course, all the students, wanted to be a millionaire. One girl didn't care. She's like, it doesn't bother me. And I was like, that's kind of cool. Out of like 50 students I talked to, like one of them didn't want to be a millionaire. She's like, yeah, if I am, I am. If I'm not, I'm like, what a great attitude. But most of them wanted to be millionaires. And it was so sad, y'all. One young lady wanted to be an elementary school teacher, but she said, I just can't do that. I'm not ever going to make enough money. And I said, girlfriend, get up here. So I brought her up to the front of the class. We chose the average salary starting salary for an elementary school teacher. We put that in. We had her save 10% of her income. And girl had like $2.6 million by the time she was 60. And it was blown away. And she was like, so I really can be a teacher? I'm like, yeah, go do something you love. I said, you can work as a cashier at the Piggly Wiggly and be a millionaire. You really can. Now, you may have to get your little side hustle here and there, cut some grass on the side or something. But yeah, you actually can do that. So I thought that was kind of cool, because a lot of them are actually thinking, oh, I can't do what I want to do because I can't be financially free. And that's exactly, and I told them my story of how I should have been a band director. That's what I was wanting to be until my band director told me the story of, hey, if he hadn't caught a catfish out of the pond in his backyard, that his family wouldn't have food to eat. And I'm like, oh, my God, I'm not even a good fisherman. I don't want to do that. Hell, who wants to, struggle for food and things of that nature? So no. Hey, I'm going to share something with y'all. I'm going to kind of go through this with you. Okay, so this is so you can follow along today, but this is my trading plan for options, right? So I just kind of wanted to walk you through how I trade options and just kind of share with you my strategy. So you remember in the summer when I spoke with Tom Shoshnoff, as Beth calls him, I basically shared my plan with him. Now, we've made some modifications based on our little think tank, but I really just kind of wanted to go through it with you. And let me just show you what it looks like. So it's kind of cool as you guys are pulling that up. Here's what the plan looks like. So you see, it doesn't matter what the market does. If the market goes up, and hopefully you can understand this risk graph, the green represents profits. So I don't care how much the market goes up. Look, if it goes up 1 standard deviation or 2 standard deviations, it doesn't matter. Look, I make this amount of money, right? But look what happens if the market goes down. If the market goes down 1 standard deviation, boom, Big Daddy starts bringing in the big money. And if it goes down 1.5 standard or 1.25 standard deviations, look at Big Daddy. Big Daddy makes a ton of money. But where you have problems with this, and this is why I wrote my dissertation on tail risk, is that you have this tail risk that could result in significant loss if the market were to go down significantly. Okay. But I kind of like this risk graph, right? It's easy sailing in up markets, and it's really good for down markets. It's just I don't need the market to go too far down. So this is my overall portfolio. Now, I want to show you a little bit of a more granular look at the risk graph in the actual trading platform. This is their Tasty Trade online platform that kind of shows you kind of zoomed out. And then I want to show you a more granular level here. Look how cool this is. So as price goes up, Big Daddy makes $2,000. It doesn't matter how far up the market goes. See that P&L at expiration right here? $2,000. Now, the line that is beige is what we call the T0 line. That is the time now, what happens today. So if the market were to go from around this 41.51 that it's at now, and the S&P 500 dropped down to 37.40 today, Big Daddy Bob would be up $16,297. Now, if this happens at expiration, when these options expire, I'm going to be up, well, wait a minute, I'd be up $7,964 right there. If at expiration, I'd be up $16,297. And I want you to watch this line. This is the T0 line. Watch what happens as I move the date forward. So the days, watch this get higher and higher. What's this, y'all? Boom, look at it raise up. See it? It gets stronger and stronger. My hedge gets stronger and stronger and stronger as the days go by. Isn't that wild? So that at expiration, I actually get this amount of money and make a lot of money if the market goes down. But I don't care if the market goes up because I make my sweet $2,000 too. All right. So I just want to go through the strategy with you because I know some of you are like, dude, I listen to the videos. I have no idea what you're doing. I've read your stinking dissertation. Oh my God, it's this stuff is hard. I'll never do this. And you probably won't ever do this, but I just want to show you what the plan is. So let's go to the plan, okay? So I call it Sweet Bobby's trading plan. So the objective of the plan is to quantitatively, I'm a quant trader. I'm not a fundamentalist. I don't use fundamental analysis to make my decisions. I also do not use technical analysis, which is the use of charts and indicators, things of that nature, to make my decision. So I am a quant trader, quantitatively. I quantitatively extract profits from financial markets utilizing the micro E-mini futures. Depending on account size and which account that we use, you actually could use the E-mini futures, which are 10 times the size of the micros. A minimum 20% annual return is desired. If I could do 12% a year, I would be Bernie Madoff, right? Bernie Madoff, of course, was a fake and a fraud. So I'm actually saying, hey, look, I'm shooting for a 20% annual return. That's kind of what we're going for. All trades are entered into an Excel spreadsheet, and spreadsheet monitors the overall portfolio metrics. Okay, so the strategy is really simple, y'all. It's made up of two primary components. Selling a naked put. A naked put basically means it's just a put. There's no protection down below it. It's naked. It's unprotected. In other words, you can lose all the way down as if the S&P went to zero. So your potential loss is pretty much infinite if the market were to go to zero. And it has a defined risk component of something called a put debit spread, which I'm going to show you as well. So here's how I monitor the entire portfolio. I control everything from 3 portfolio metrics. Now, it is my assertion that you, ladies and gentlemen, could manage a billion or multi-billion-dollar portfolio using these exact same metrics. Okay. So the first thing I look at is my directional risk. Delta represents the directional risk of my portfolio. So I SPY beta weight my deltas so that they should not be more than 0.0015 times the portfolio's net liquidation value. So in other words, if I have a $100,000 portfolio, $100,000 times 0.0015 means I would not want my SPY weighted deltas to be greater than 150. So in a $100,000 account, my maximum deltas would be 150, which means my maximum exposure would be the equivalent of owning 150 shares of SPY. Okay? So that's the first thing I look at. The second thing that I look at is my theta. Theta is the fuel upon which our portfolio runs. Theta is the sweetest thing in all of options trading. It is the apple that decays, right? We sell something that we don't even own to people and they buy our little options that we sell. But we've got to buy those back or let them expire worthless. So a primary goal is to always maintain a minimum theta of 0.001 times the portfolio's net lig. So in other words, in a $100,000 account, I want to maintain a theta of $100. Now, what does that mean? In good times and bad, though theta decay is not linear, if I have a theta in my count of 100, that means all things equal, old sweet Bobby's going to make $100 a day if everything goes right. Okay. So basically, then I say, hey, I can even use more theta in my account, and it depends on what the VIX is. Does everybody know what VIX is? Okay, it is the volatility index. It's the fear index. So I actually go in and look at what VIX is. So I can type in VIX. Oh, my password. Hold on a second. What is it? I changed it. Here we go. So the VIX is at 18. Okay. So if the VIX is at between 15 and 20, I go a minimum theta of 0.1%, regardless of what volatility is stating. And I can go up to 0.2%. So I could go up to $200 of theta now in a $100,000 account. So remember, when volatility goes up in your life or the markets, that's when you and I, ladies and gentlemen, take more risk, right? When crap hits the fan and everybody is scared, that's when old Bobby goes in and says, hey, wait a minute, I can take more risk. I could go up to $500 of theta in my account, which means I will have sold more options premium to meet my goal of that maximum theta. Minimum is always going to be 0.10% of my portfolio. Maximum is going to be 0.5 if the VIX is above 40. And VIX is the only mean reverting asset. Where is the mean of the VIX? About 17 or 18. That's where you generally see it. So right now we are at the mean. We are at 18. Now, let me show you, because I've showed you before. Let's show you VIX. This is what VIX does. This is a daily chart of VIX. VIX raises its ugly head and people get scared. And then what do? They get complacent. And then they get scared again. And then they get complacent. Then they get scared again. And then most of the time they stay complacent. And then all of a sudden we've got a bank crisis. Oh, God. So the VIX raises its ugly head. And then they go, what bank crisis? And so if you'll notice, this little thing does this continually. What's this, y'all? It's the only mean reverting asset that there is. Look at this. It always and must, by definition, revert back to its mean. Isabel has her hand up.
So your percentages on that form, that doesn't matter what the actual balance is. So you're saying over after or using like $100,000 account.
Yeah.
If I were to have like not that much in there.
Yeah.
I could still use those numbers.
Yeah. So probably to do this strategy, you probably need a minimum of $5,000 to run it. You know, and I mean, you could run it with less. $5,000 though is kind of, it's kind of, you could play with it, but you're going to do it on a little small scale. Okay.
But I could use it with like my paper money account.
Oh, absolutely. Okay. Absolutely. Yeah. If you want to run that and see how you do. And it'd be interesting to see, Isabel, if you could make 20% a year, right? You say, oh, man, I can do that. Let's see. So let me see if I got my little drawing tool. Where's my little pen? So what I do is pretty simple, y'all. What's this? I sell options, which gives me premium. It's like an insurance, right? I'm like an insurance agent. I sell premium. I receive premiums for the options that I sell. Then I let theta decay. So if my theta, Isabel, is $100, how much should I make a day in my account?
1 point.
I should make my theta every day. I should make theta of $100. If my theta is 100, I should make 100 every day. All things being equal. Here's where you can become multi-gazillionaires. You ready? I manage the chaos. This is the hard part. This is the part that tries men's souls and women. And then I rinse and repeat. Then we go back again. We sell more options. We allow the theta to decay. We manage chaos, and we rinse and repeat. That's in a simple nutshell what I do. Okay, really, really, really simple. So let's look at it in practice and go through the plan again. So let's get back to the plan. The third metric that I use is buying power. Buying power ensures the portfolio's overall position sizing is not too large and that the portfolio is not taking too much risk. So buying power is the amount of collateral that the broker is requiring me to put up for the options that I sell. So I also allow myself to take more risk as the volatility increases. Right now, we have a VIX between 15 and 20. So I am allowed to use about a third of my net liquidation value. This is my account value. So if I have a $100,000 account, I can use up to 30% of it to sell my little options. If the VIX goes up to 40, above 40, I can go up to 50% of my net liquidation value. Any questions on buying power? And you'll see it when I actually kind of go through a trade, right? To kind of set it up for you. So those are the three metrics. And Isabel, I think that you can manage a $5,000 portfolio with this, or you can manage a multi-billion-dollar portfolio with it. You could be a hedge fund manager. Okay. if that ever suits your fancy. All right, let me tell you the components of our strategy. The strategy involves either a 1-1-1 trade or a 1-1-2 trade. You're going, what the crap is that? Well, a 1-1-1 trade is comprised of two parts: an out of the money put debit spread. I'll go through this, and one out of the money naked put. A 1-1-2 trade is composed of let's get Sadie out of here, a single out of the money put debit spread and two out of the money naked puts. Out of the money means it's below the current price of whatever the S&P 500 is. Ideally, a 1-to-1 ratio of naked positions to put debit spread is preferred. So if I'm putting on a naked position, I will put along as well a corresponding put debit spread. Now, I know this is really, really deep, and this is really, 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 really kind of boring stuff, but you'll see as we go through. So a put debit spread is bought. So I buy options and I sell options, but I buy put debit spreads. I buy them at an expiration that is closest to 60 days without going under. Why 60 days, Bobby? Well, that's kind of where I'm comfortable doing it. I like putting my risk out for about 60 days. I make the put debit spread 50 points wide, and I do it at a cost that's about $10. So $10, it'll reflect $10, but there's a 5 times multiplier in the micro e-minis. So it actually cost me 50 American dollars. Ooh. So let's set one up. You ready? So I go to the micros /MES, and I'm going to set it up over here just because it looks cleaner. But you can certainly do this in Thinkorswim, and I'll don't mind showing you over there, but I do want to show you over here how I do it. So I go to the table mode, and I go closest to 60 days without going under. So here's the 63 days, right? So I go there. And in Tastyworks or Tasty Trade, you can just do a long put vertical. That's a put debit spread, long put vertical. So I hit go. So that is nothing more than buying an option and selling an option farther away from the money. And remember, I say that I like them 50 points wide. So that means I move this, the sold option, down 50 points below my long. So I'm buying the 4160 put. I'm buying the 4110. And I like to do that at a price that is set $10. So I've got to move them farther away from the money to make that cheaper. Watch what happens to the price as I move the strikes lower. It went down to 1675. I moved my strikes from 4150 to 4100. Now I'm going to go to 4440 to 4090, and it moves it down to 1625. So I basically just kind of keep moving them down until I get down to about $10.
And what does the strikes stand for again?
This is the strike price. So I'm buying the current price of the S&P 500 here is 4165.
Okay.
So I'm buying a put at X strike and selling a put at this strike. The strike price is, how do I explain it? When you sold a put, you sold the 3980 by itself. That makes money as long as the price of the underlying, which in this case is the micro E-minis, does not go below the 3980. When we're setting this up, and ignore these other positions that I have here, I'm going to move this down to 4020, 3070, that's 1075. Let me go down a little bit longer. It gets caught on these. So there's $10 right there. Okay. So I'm buying the 4,000 and selling the 3950. Well, what does that look like? Well, first of all, if I were only doing this, I'd be a dumb butt because it only has a 29% probability of making a profit. Ooh, that's no good. That's no good. It's going to cost me $50, so it has a negative 50 extrinsic value. It gives me a little bit of short delta. It actually has short theta. Oh, that's not good. But it does have a maximum profit of $200. The maximum loss is the amount that I pay for the debit spread. And they're going to charge, well, they're going to not charge me. They're going to give me buying power relief of $64 for putting this on. So this almost like they're saying, please do this, Bobby. Please do this. It makes your account safer. Well, what does it look like? Let's see what it looks like, okay? So let's go to, let me go one more. Review and send. Okay, so here we go. So now I'm going to go to curve, and I'm going to go to analysis, and I'm just going to show you the put debit spreads. Let me uncheck everything and show you what it looks like. Isabel, you're going to love this. So let me get this down. So the green area shows you where old Bobby makes profit, and the red area shows you where old Bobby loses money. So we are currently, let me zoom out here. We are currently at 4165. See this little flag? That's where the current price of the S&P 500 is. The micro S&P 500 is 4164. So this is the little flag showing you where it's at.
Okay.
I'm buying a put debit spread. Now, I will lose $50 if the price of the underlying stays at 4160, or if it goes up to $1 million. It doesn't matter. I'm going to lose my $50. I will also lose my $50 if at expiration it goes down to 4,100 or 4040. I only start making money when the price of the underlying, the micro E-minis, goes down into this profit tent. And if it stays there, I make the maximum profit of $200. How do they figure out $200? Well, it's 50 points wide, right? 50 points wide times 5 is 250 minus the $50 that I paid to get the spread. That's my max profit at expiration. So, Isabel, this is a bearish strategy if it was what I did by itself. Okay. Everybody see that this is bearish? And it doesn't matter. The market could go down, to zero, and I still make my 200 regardless. Look, if the S&P 500 went down to 860, I'd probably be moving to another country anyway, because that would be horrible going from 4165, but it doesn't matter. In this particular instance, old Bobby makes $200 at expiration. Now, you're not going to know all of this at once, but I'm just giving you a deep dive into what I do. Okay? All right, but that's not all. That's the 1-1 of the 1-1-2 or the 1-1-1 strategy. So if I want to do a 1-1-1, I have to sell a naked put. Okay, let's pretend we're doing the 1-1-1. So let's go back to the table mode. And first of all, let's go back to our document that shows you the management of this. Management of that put debit spread. Under normal circumstances, the put debit spread expires worthless, and I'm going to lose $50. That's just the price of me doing business. It's the price of me having a little bit of hedge for the actual money maker in this strategy. Permission is granted to close the debit spread before it expires if the spread is approaching 100% profit. In other words, if I've got $190 profit on it, I might want to close that and to take my profit, or the current price of the underlying is under the profit tent. What's the profit tent? Profit tent is this.
That green spot.
Yep. So if the price is in this profit tent and the spread is at risk of, and the put debit spread and is at risk of exiting the profit tent if not closed at a profit. So in other words, if the price moved right here and it's like, if I don't close it now, I'm not going to get any of this profit. So I might close it rather than letting price go boom out here again. So that's some of my permissions. I will also close it before any expiration if any leg of the spread. What is a leg of the spread? That's a strike. If the 4,000 or the 3,950 are at risk of being in the money, which means the current price would be past that strike, then I would also close those to avoid assignment and exercise fees. How do I explain that? If this put, which is a long put that I'm buying, expires in the money, then I wake up the next day short a futures contract. If the 3,950 is in the money, in other words, it's above where the current price of MES is, say, for example, 3,920, I wake up the next day and I am long a futures contract. Well, if they're both in the money, I would wake up, net long a futures contract, short a futures contract. They would cancel each other out, but the broker would still charge me $15 a leg. 15 because this was assigned, 15 because this was exercised. Sounds a little complicated. I know. I don't expect you to get this all. I just kind of want you to have an idea of what I do. All right. The second component of the 1-1-1 or 1-1-2 trade is either one put or two puts are sold. Same thing. Days to expiration are 60 days without going under. The strike, I will sell a single put to collect approximately $20 or two puts to collect roughly $10 to $12 each. Okay, let's look what that looks like. So we'll go back here to the table mode, and we're going to do a 1-1-1. So I like to collect about $20. So here is the 3680 put that I can sell for $20. Let's see what the combined trade looks like. Okay, so I've got a put debit spread up here, and I've got a naked put down here. What does that look like? Well, it kind of looks like this. Now then, now we got us something. Look at this little, what do you want to call that? Like a submarine, y'all. Look at this. Now all of a sudden, this combined trade makes me $50 regardless of how far the market goes up. It makes me $50 if the market goes down from 41.60 to 41.20. If it goes down to 40.80, I don't care. Look at this, y'all. It still makes money here at 40.40. And look, I make $300 if price goes into this little area at expiration. But oh, woe is me. Look what happens if price keeps going down here. Unbelievable. All of a sudden, oh, Bobby has a number of losses. Look at that. If the market goes down to 3,400, I lose $1,000 and what is that? $91. Okay. Just want you to know the risk. And the risk elevates as I go down. So if the market dropped down to 3,000, I got a $2,800 loss. Oh my God, if the market keeps going down to 2,280, I've got a $6,000 loss. So watch this. This, though, trade, y'all, this is where it gets good, though. I've got a 96% probability of success. How many of you would go to the blackjack table and play all night long if you had a 96% probability of winning each and every hand? You with me?
What's the lowest possibility that you are comfortable with?
Look, it's a good question, because you can make money with options with a 10% or 20% win rate if you're doing the right trade. I'm comfortable with this. I'm comfortable of being in the 90s. And that's what this trade does. It has a 95 or higher percent probability of success.
Okay.
The max extrinsic value, that is, if the market goes up, is the 50, right? See, the maximum profit I make there is $50, 51, right? That's the extrinsic value. It gives me positive deltas, and I love positive theta. It gives me theta of 52 cents a day. Oh, Bobby will be making 52 cents a day on this trade. My max profit is if it expires in this area here. My max loss, if the micros were to go to zero, are $18,000. But the broker apparently does not think that the market's going to go down to where I'm going to lose $18,000, because they're only charging me $589 in buying power to put it up, which kind of means that they kind of think that the risk on this trade is probably a max loss of around $600, because that's how much collateral they're charging me to do the trade.
And then how many of these do you do? Well, I mean, how many of these did you start off doing?
Well, I'll show you that in just a second too. I'll show you that. Okay. So let's see how we manage this. All right. The management of the naked puts are usually closed at 21 days left in the trade, regardless of profitability, but subject to overall portfolio metrics. So I will hold them from 60 days down to about 21 days. Then I may put on a new put debit spread as well, with each new naked that I put on in the same expiration. If how do I explain this? 30 delta breach. Okay, this is another management technique. Let me show you this. So that naked put is at a delta of 10. We say this is negative 10, but we call that a 10 delta. It has a 10. Delta is an approximation of probability that it's going to end up in the money. In other words, the probability that this 3680 is going to end up in the money, which means that the price of MES would be below 3680 at expiration, is 10%. So I've got a 90% probability that this is going to be a winning trade for me by itself. So the delta is 10. Now, as price moves downward, so if price goes down to maybe say 3,800, the delta will increase. And if the price moves against me, this delta at some point may become a 30 delta, which means there's a 30% probability that this is going to end up in the money and lose me money. At that point, I close it when it's a 30 delta breach, and I roll it back out in time. God, is that complicated, and you're not going to get it now. You're not going to get it, y'all. You're not going to get that now. So I don't want to spend too much time on it now. But if it becomes a 30 delta, that means crap has hit the fan. That means that the market has dropped big time. And my 10 delta option has become a 30 delta option. I give myself permission to place it in problem child status, keep up with the debits and credits of the trade to make sure that it is ultimately profitable. Do I even want to go through this or not? Do I even want to show you this? Yes, I do. Y'all are ready for this. So I would close the put at a loss. Let me show you what it looks like. And I have had trades in problem child status. So in my spreadsheet, I've actually got something called problem children. So the initial trade, I brought in credits. So let's keep up with credits and debits here. Okay. Credits, money coming into me, and debits are money coming out. I put on a 1-1-1 trade and brought in $408. So that's like somebody paid me $408 for me selling this little 1-1-1 spread. Okay. The market dropped against me. And remember, I told you that sometimes the apple that we sell swells up the size of a grapefruit. Mm-hmm. Well, it sure dang did. Because what happened is, as the market went down, my options got bigger. And the next thing you know, I had to close my naked put for $1,600. Y'all, that was a $1,200 loss. Ouch. And this is a $25,000 account or $30,000 account. So I lost $1,200. But you know what I did? I went out and sold another naked put farther out in time. I extended duration and I sold another put farther out in time, farther away from the money, and I collected another credit of $1,600. Wow. So keep in mind, I'm taking additional risk, though, by selling another naked put. So I've lost $1,200, but I all of a sudden bring in $1,600. Then I closed the put debit spread. The little thing that showed you I could make $200 on, I made $200 on it. I took my profits from that. So that took my losses down a little bit, right? And then when volatility settled back down, I was able to close that naked option that I sold for $1,600. I bought it back for $400. So I made $1,200 here. I made $200 here. I lost $1,200 there. If you put it all together, Isabel, old sweet Dr. Bobby here made $200 on a trade that was initially lost $1,200. That is an amazing way of managing trades. And you're not going to understand all this that I'm telling you now. I just want to expose you to it. I want to expose you to what is possible. I went from losing $1,200 to making $200 on a single trade by defending the trade. See, that's the wonderful thing about options, y'all, is that we can have all different kinds of management that you can do on these things. All right, so let's go back to our little document. Okay, so we talked about rolling out in time. When you roll it out in time, that increases my delta. Well, the overall strategy is positive delta, positive theta, and it does take up buying power. Okay, the entire strategy does. All right, trade entry is dependent on the Greeks. That means my deltas and my theta and my trade metrics, delta, theta, and buying power. If all three metrics are at permissible levels, a new opening trade must be initiated daily. If any of my metrics are violated, no trade will be initiated unless my theta is below 0.001 of my total account, blah, 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 blah. And you're sitting there going, how in the name of God do you keep up with this? Ladies and gentlemen, I present to you my baby. Ta-da! My little baby. This is my little spreadsheet that I come in and track my account every day. Okay. So I trade a number of accounts. This one is a $35,000 account. Now, before Volmageddon happened, I was up 9.65% on the year. I was killing it. Volatility went against me. I had a day where I lost $3,100. It's all temporary. But I have fought my way back to now I am up 3.44% on the year. Okay. So my little 30-something thousand dollar account here has made $957. I'm at 3.44%. Okay. So I list every trade into my spreadsheet. Let me show all of these to you. These are my open trades. And let's show all. Yeah. So you see the trades, the put debit spreads, and the, don't worry about that, the put debit spreads, the naked puts, I keep up with all of them. The green ones are positive. Those are winning trades, and the red ones are losing trades. And I track them separate, right? Even though that's a single trade, I track the naked separate from the put debit spread. So the put debit spreads usually always lose money. That's just a hedge that allows me to do the naked ones. All right, so this keeps up with all of my little trades, Then I track my Greeks and ratios every day. So let's look what happened today. My deltas are 31. Where do I get that? Well, I go to my platform and I go over here to monitor tab, and let me take these groups off. So my deltas are 35 minus 2. I have to combine those. So I've got 31 deltas, and my theta is 37. If all goes well, I should make $37 a day in this account. All right. My P&L year to date is $1,700. Some of that's from my T-bills that are in here, right? $1,700. Up $1,400 on my open trades. But this is where I get my metrics. How much is my buying power? I know you're getting frustrated. I don't count buying power on my T-bills that I've got in the account, right? I count it just on my 111 trades. So my 111 trades are taking up $9,942. And I record that in my spreadsheet. And I've got everything color-coded so that it automatically tells me if I'm good or not. So my deltas should be conservatively no higher than 53. I'm at 31. My theta should be at 0.1%. It is exactly at 0.1%. It can be no higher than 0.2. My spreadsheet tells me all of this. All I have to do is put in the VIX every day, and it tells me that I should be using no more than 30% of my buying power. So my account is good. So in this situation, I go, do I need to put on a trade or not? No, not really, because I've got my minimum theta and everything looks really good. Questions so far? Have I lost everybody?
No, I'm good.
This spreadsheet has taken me, honest to God, it's a culmination of a lot of different things, but I would say I started working on my spreadsheet 10 years ago. And in different fashions and different things. And this thing actually tells me when to close trades. What's this? Let me just show the blanks, which will be my open trades. So these are my open trades, right? So if my naked put gets below 21 days, it'll tell me to close it. What's this, y'all? So 21 minus 58 is what? Well, let's see. Let me just go. Let's say this was, I don't know, 39 days. No. Current days. Oh, that's the wrong one. Hold on. Don't mess your spreadsheet up, Bobby. It's here. Here was the original days to expiration. So if I was like started out at 65, and it would say I have 6 days left in the trade. When this got to 21, it tells me to close it. Little old Bobby's got a spreadsheet so smart that I designed it to tell me when to close my trades, right? So it tells me, hey, Bob, it's time to get out of the trade, roll it out in time keep doing the thing, rinse and repeat. All right. So let's go back to the document. I do have optional hedging. So I'm not going to go into this much. The Sweet Bobby hedge that I do, I could buy puts, which is what most people do to hedge portfolios, or I could do the VIX hedge. Okay. This, ladies and gentlemen, is what I did my dissertation on. This is my dissertation. Buying VIX hedge to hedge my portfolio. Just wanted to mention it. So a lot of you say, what was all that about? And the reason that you do that, the reason that you buy VIX calls is to hedge the downside tail risk of a portfolio. Okay. So I talk about treasury bills and how I implement treasury bills into my overall strategy. Then I talk about, now here's where you manage the chaos, y'all. So if any of my Greeks or ratios are violated, permission is granted subject to my risk tolerance to adjust the portfolio by doing the following. I could close a profitable position. What do you mean by that? Well, Bob, look. I mean, if the market goes against me today, I don't really care because I've got a lot of profitable things that I could close. Look at my naked put, y'all. This naked put that I sold when it was 60 days, now only has 36 days remaining, is at 85% profit. If the market or my metrics get out of line, I could easily close that and take my $145 of profit, right? It's made me $12.50 today. I've got another one at 85%, 84%, 82%, 81%, 74%. Look at all these things, man, that are just decaying and bringing in money into my account. I could close any of those. So I can close a profitable position. I can roll a losing position to extend trade duration. That means I could close it and roll it out further in time. Remember the trade that I put in problem child status earlier? That's what I did in one of those trades. Then I could also sell 10 delta calls. So instead of selling puts, I could sell calls. I could sell futures contracts to adjust my buying power and my deltas. I could buy cheap puts. I could close losing positions and just don't reestablish them. And this is probably beyond what you would understand at this point. But I've also got in my plan what each one of these things do. If I want to decrease my delta, I can either close or roll my existing positions. It will also decrease my theta and decrease my buying power. If I sell a futures contract, it decreases my delta, it's neutral on my theta, and it decreases my buying power. If I buy a protective put, it decreases my delta, it decreases my theta, decreases my buying power. If I sell a call, blah, 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 blah. This is my process. If I love this process, if I respect the process, if I trust the process, if I follow the process, then winning a championship, which means having a wonderful trading year, is the inevitable result. I'm really big on the Nick Saban process. He came in and implemented a process at the University of Alabama. I have a process by which I trade my account. The process is very detailed, and I have created my own spreadsheet that basically tells me what to do and how to manage the overall account. Boy, did I throw a lot at y'all.
And how do I get a copy of this?
I will give you a copy of this.
Awesome.
Yeah. And it's fun to play with, right? And you'll have a lot of questions. But what you could do is like start following along with my little daily things that I do every day on my Sweet Bobby channel, you know, or you're in Discord, right? I post a live Discord link every day. Come in there. And by about 2 weeks, you'll be an old pro with this. I know right now you're sitting there going, oh my God, this is, you know, I could never do this. Yeah, you could. It's actually very simple because the program is nothing but this. Let's go back to its simplest form. I sell options on things that I don't even own. And people in the market pay me premium for selling those options. Now, Isabel, why are they buying those options? Why do most people buy options? As a hedge. So I'm providing insurance to these people. They give me a premium. After I collect the premium, I allow the theta in my account to decay. In other words, that option that I sold usually decays and rots off. So whatever my theta is should theoretically, in a perfect situation, be the amount of profit that I make per day. My job, more than anything, is the chaos management. This, Isabel, is where you could be a hedge fund manager. If you can manage the chaos around the collection and theta decay, the collection of theta and theta decay, managing the chaos. Now, how often do we have chaos? About 5% a year. So there's 252 trading days, right? So out of 252 trading days, I think in probabilities. So about 5% of the time you're going to have, you're going to be on your toes, which is the equivalent of 12.6 trading days. I had such an event in March when volatility raised its ugly head. My options that I sold, which were the size of apples, swole up to the size of pumpkins during this event.
Yeah.
And all I had to do was manage the chaos. I closed some trades. I sold some futures until everything settled back down. And now, since I've done that, little old Bobby is back to printing money every day. I made $66, $192, $29, $111, made $13 yesterday. I made $105 today. That is the collection of theta. That is managing chaos. Now, keep in mind, we'd probably be at 12 or 13% had I not had that. Okay, no big deal. I'm coming back. I was at 9.48%. I'm at 3.44%. Coming back. And this is chess. Think about playing chess in 3 dimensions, right? You got a chessboard, but let's even put 3 dimensions. You got 3 chessboards lying on top of each other, and that's how you're playing chess. Oh, and I don't know if I've conveyed my passion for this, but I love this stuff. Oh my gosh, I love this stuff. It is the nerdiest stuff. Theta and delta and gamma and vega and all this stuff that we talk about. But options, y'all, creates a very, very fun board game if you're ever interested in it. So fun. Katie's like, screw this crap. Girl has already tuned out. She's like, forget it. She's sitting there going, you do you, boo.
Like I've said, this is one of those, if I was studying just this and nothing else,
right,
I could really dive into it. One day.
I'll say this.
Katie, you just keep letting that money roll on by you.
Can I tell you why I do this? Now, this is, y'all like this. You'll think this is fun, right? So back when Chris Moneymaker won the World Series of Poker, that is when ESPN started showing poker on TV. And everybody, y'all know people that started playing poker because of Chris Moneymaker winning the World Series of Poker. So what I did is I started playing online poker, okay? And I got really good, y'all. So I, on vacation, was taking poker books with me. I'd get poker books out of the library. I was studying poker. I was watching every gambling and poker movie out there. My wife, I went to my first live tournament out of 212 people. I won first place, and I went on to the next level where I lost immediately. But I mean, I was doing pretty good. And so I was actually gambling online in the poker world. And my wife was like, you are a degenerate gambler. You cannot do this, Bobby. You are scum of the earth. And I'm like, oh my gosh, you made me feel so bad for being a gambler. Here's what Beth said to me. She said, Bobby, why don't you do something in finance and in, with your trading or something like that? And I go, okay. So I threw away all my poker books, and I started getting options books and trading books. And, it's just been a a rabbit hole that never ends, but it is so fun, y'all. It is so fun. So Beth has no problem with me doing this, but she had problem with me gambling. So I think of myself as a quantitative strategist, right? That's what I do. I quantitatively extract profits from the market. That's what I do. Any questions? Any comments? So that's just a high level look at what we do and why we do it. Here is where opportunity is, y'all. This is where opportunity lies. When VIX raises its ugly head, but when it does, your existing positions are going in the tank, right? Because the market is inverse to this. The market's going down mostly when this is going up. And then look at human behavior. You can tell so much about human behavior. People forget. People forget about the banking crisis or whatever was happening. And then they get scared about something else. Oh, God, Russia's going to war with Ukraine. Oh, yeah. Okay. And then it's like, yeah, that's a big deal. Oh, wait, I'm scared about. Oh, no, well, that's nothing. And, oh, no, I'm scared about the banking crisis. And over and over and over. Let's look at this. Let's go back to the COVID crash. This is where I made 208% in a single week, right? I mean, my account was like, I was so happy. So let me show you. Let's see, day, 1 year. Let's go to 4 years. That 4 years. So where's 2020? 2020, September. That's not 4 years, is it? Daily chart, 5 years. June 25th, July. Hold on, let's go back here. Oh, here we go. We can't, it's not letting us go. Look at this, y'all. This had to be COVID right here. Look at that. Yeah, 3/16/20. Here we go. Life was going along just fine. Just fine. No problem. Life. COVID. We're closing. Oh my God. And VIX went to 82. And this, I swear, as God is my witness, this is when I'm sitting in my podiatrist office and he's like, look, dude, I'm putting you in the hospital. We're cutting your toe off. And I'm like, I just made 208% right there. So you and I can take advantage of volatility increases, right? Because it happens over and over again. But look what happens. COVID, what's this? People, it doesn't take long. Look, what happens? We revert back to the mean. It is the only asset that reverts back to its mean. Shannon had to go. She's got to get back to work. All right. Questions, comments? What are y'all doing? Isabel, you got your other class going. What's going on with you, Katie?
Work and then the insurance class.
How's the insurance class going?
It's good. It's
No, it's not.
Are you in the insurance class too?
Yes.
Hey, hold on a second. Let me stop the recording so y'all can talk freely. Hold on. I like hearing all this stuff. Hold on a second. Let me stop my recording. Let's see. Stop
He
the
was
shit.
doing so good